The bankruptcies of two companies in the auto sector have heightened concerns around certain parts of the credit market. Glenn August is founder and CEO of Oak Hill Advisors and joins us now here at Case. It's good to see you.
Good to see you.
So you do business in many parts of credit, right? Private credit, leveraged loans.
Yep.
Last year at this conference, I sat here asking people if there was a bubble in private credit. I think it's relevant now to ask you whether we're starting to see the first cracks in that whole story.
I do not see a bubble in private credit. The companies, yes, there's isolated instances. You refer to a couple of bankruptcies. There's always idiosyncratic credit risk. But if you look at where the economy is, if you look at where the equity markets are today, if you look at the balance of where we are from inflation, growth, et cetera, I'd say the backdrop is still reasonably solid, but that's not to say there's not risks in the market. I love Jamie Dimon's comment today that if there's one cockroach, there's probably more.
I was literally going to ask you about that, okay? Because you said idiosyncratic. He suggests maybe not so much.
Well, again, idiosyncratic is a question of how many cockroaches are there. Okay, so if we look at the market today, in the leveraged loan market, in the high yield market, there's less than 5% of credit trading below 80. Generally less than 10% trading below 90. There's really idiosyncratic risk. And where's that coming from? There's issues with some companies that are impacted by tariffs. If you're importing tools from China, guess what? You have higher costs today. Okay, there's impacts of AI. Some companies are challenged on their premise, will AI make them less relevant? Some companies can use AI. And then interest rates have been higher, so costs have been higher. The subprime consumer has been challenged. So there's credit risk. But you know what I think about is that the credit market is not the equity market. In the equity market, the Mag 7 is 35–40%. In the credit market, there's hundreds and hundreds of companies.
Much deeper.
Each one of them has their own story. And so for people like us who pick credit and have been picking credit for decades, we still see good opportunity, and I don't see a private credit bubble. I don't see a bubble in our markets. That's not to say there can't be a few extra cockroaches around. There'll be alleged fraud from time to time. There'll be cyclical challenges, but by and large, there's still good opportunity in this space.
So a few other cockroaches around is different than this being a canary in the coal mine?
That's what I think. And again, as I've been doing this for almost 40 years, you need to really have distress, you need a recession and you need forced sellers. And today, I don't see a recession anytime soon. And the markets have evolved such that the credit markets, there's not forced sellers. There's not that much mark-to-market leverage in the system. The bank loan market is CLOs. The high-yield market is over 50% BB. The private credit market is all bilateral negotiations. So I think there's good opportunity. And as private equity starts to deploy more capital, there's really good opportunity to deploy capital. There's good opportunity for the wealth channel. I saw your previous interview. And again, it does not make sense for individual investors not to have the exposure to alts.
What do you make of this today from Bank of America's fund manager survey? 57% of respondents said private equity, private credit is the most likely source of a systemic credit event, the highest conviction on the source of such a disruption since 2022.
I have looked at that survey for years and normally take the other side of the survey. In my view, what I would say on private equity is that I think returns will be lower. It is more competitive. Interest costs are higher. And I don't think private equity will deliver the returns, which is why so many of our investors are allocating capital from private equity to private credit. I don't see it.
So let's take it from the angle of you obviously aren't too concerned by what you can see. The whole nature of the shadow banking system is what you can't see because it's so opaque. So how do we truly know what is hidden in various places out there that we won't know about until it starts to get really heated up?
There's so much talking about the shadow banking system, but let's put in perspective. When we do senior direct lending and get paid 8 or 9% unlevered, we occasionally, for some of our accounts and funds, will lever that 1-to-1 or 1.5-to-1. That's not 10-to-1 in the banking system. The companies that we're lending to are more than 50% equity cushion. And so again, I think this whole fear is overblown. It's held by long-term capital. We have 8 of the top 10 sovereign wealth funds, 15 of the top 20 largest U.S. pension plans. They are long-term investors, and they can take that illiquidity premium. And so, again, I don't want to say that there's not risk. There is credit risk always. That's why you get paid 8, 9, 10%, or in special sits 10, 11, 12, or higher. You're taking credit risk. You're taking liquidity risk. But that doesn't mean there's a canary in the coal mine and that we're heading towards it.
Lastly, has this forced you, though, to look in your own book and then just go over it once, twice, and 10 times?
We look at our own book every day. Nothing has forced us. We've been looking at our own book every day for 38 years. So the answer is you always have to be on top of what you own every single day.